Good morning, everybody. My name is Anthony Kazazis, and I am the director of the NYC Network Group, as well as the NYC Real Estate Expo. And I want to thank you guys for all coming on and registering for today's webinar, sponsored by Next Generation Trust, SDIRA 101. That's Self-Directed IRA 101, the basics of investing in real estate with Self-Directed IRA. Today's session will overview the basics of investing in real estate through a self-directed IRA and how to set one up. Next Generation is a custodian and an administrator for self-directed retirement plans, which allow investors to diversify their portfolios through non-traditional investments. These non-traditional investments are non-publicly traded alternative assets, which include real estate, private equities, notes and loans, cryptocurrency, precious metals, and more. Next Generation Services is an administrative arm of the business, while Next Generation Trust Company acts as the custodian for all the accounts. Next Generation Trust Company is licensed and chartered in Sioux Falls, South Dakota. Its administrative office is headquartered in Roslyn, New Jersey. Next Generation's mission is to provide white glove customer service, ensuring that clients have the tools and support necessary to control their financial futures by investing with self-directed retirement plans. They fulfill this mission by educating individuals and their trusted advisors about the many options and benefits of self-direction and guiding their clients through the setup and investment process. Our guest speaker today is Brittany Melville, Next Generation's Director of Marketing and Sales. Brittany applies her extensive experience in the direct sale, marketing, and customer relationship management at Next Generation Trust. In her role, she develops and oversees the marketing strategies across all media and works with the team to support sales initiative. Without further ado, ladies and gentlemen, our special guest today is Brittany Melville. Welcome.
Thank you. It's nice to be back here again, although we're virtual this year, but nonetheless.
Yeah, that's true.
Yeah. All right. I guess we can get started. I'm excited to take you guys on an educational journey today. Everyone here is interested in real estate, I'm sure, and today we're going to talk to you about a really powerful tool that you can incorporate into your investment plans or even just your retirement planning that includes real estate. The self-directed IRA. So going to talk a little bit about conceptually for anyone who's kind of new and unfamiliar with this, kind of what actually it is and what makes it different from a regular IRA that you might be familiar with. And then we'll get into the specifics on how real estate investments can work and some of the rules and regulations that are important to be aware of. I believe the session's being recorded for anyone who might have to hop off or wants to have a reference after the session. And we are going to welcome questions once we go through the initial piece of this. So I will just jump right in. As it relates to self-directed IRAs, Next Generation as a company serves as the custodian and administrator for these retirement accounts. So we're basically a financial institution, not a financial advisor, but an institution that is responsible for helping establish these types of IRAs and hold them. And then we do all of the tax reporting and the record keeping on them. Sort of like if you had an IRA with a bank or brokerage house like Fidelity, how they would sort of be responsible for servicing your account. So that is essentially what we do. And we're very focused on education because this topic is something that tends to be unfamiliar to many people, despite the fact that there are many sophisticated investors out there and lots of people do have retirement accounts, but this specific niche is new and foreign to some. So we love to educate people to give them the ability to empower them to make these decisions and explore this as an option. Quick disclaimer, we're not financial advisors or we're not fiduciaries. So we do not sell investment products. That's one of the biggest differentiators from what I think people are used to hearing. And we don't endorse any specific investments. But what we do is provide education on how to establish these accounts, the process to follow, the rules to be aware of. And it is important that each investor understand that they are responsible for doing due diligence on any investments that they choose. And that, of course, there's risk associated with any investment. as always. A quick background on the company. We've been in business for 16 years, women-owned business in New Jersey, and our founder and CEO is still with us, involved in the day-to-day operations. She actually founded the company through her background in real estate. She owns a property management company. She's a licensed broker in New Jersey, and she actually was looking for ways to put real estate investments in her retirement account. And then in discovering how to do that, came across the self-directed IRA, felt very passionate about this, and wanted to spread this education and the service to more individuals. So that's how we came to be. And we do contribute a lot of content in some different publications in the finance space and the real estate space as well. So, okay, let's get to the good stuff. So what's actually a self-directed IRA? It's essentially like any other IRA that you might have come across, in the sense that an IRA is designed for long-term investment, right? You're going to put money into a retirement account and you're going to invest it strategically, with the hope that that value of your initial funding and your initial investment is going to grow and accelerate your wealth over time, so that when you decide, you're tired of working one day, you're able to relax and maybe have a margarita on the beach because you've worked hard to save money that you can now, spend at your leisure. So self-directed IRAs work that same way. Concept is the same. The biggest difference is that instead of being restricted to publicly traded assets like stocks, bonds, and mutual funds, which I think initially come to mind when you think about IRAs, you have the ability here to open up your options and include what we call non-traditional assets. So those are things privately held, not traded on the stock market. So that's going to give you a whole different avenue to pursue in terms of further diversifying your portfolio, because now you're not just invested 100% in the market. You don't have quite as much exposure to market volatility, because now you're invested in these alternatives as well, which tend to be non-correlated with market performance. So over time, you could potentially see more stable returns in your overall portfolio. And then, of course, if you're doing these investments already, like real estate on the side or in your business or on a day-to-day with your personal funds, you're responsible for paying the taxes when you're recognizing earnings on whether it's rental income or capital gains, whatever it might be. But when you do these things in an IRA, now suddenly you're using a tax sheltered vehicle. So anything that you're earning on the investments that go back into your IRA are now not going to be taxed at that time. And we'll talk more about different account types and how that can work. But essentially, that's really the biggest distinction here. The idea is to give you more freedom and more power to decide how you want to invest your retirement funds. And if you know that you can get really good returns, for example, on the flips you're doing or the rentals that you're holding, and those returns are going to outperform what the market is doing, then this is definitely a way that you could further accelerate that wealth for yourself. So why this is important, and I think many people are aware of this now, is that the retirement landscape is changing, right? So historically, American workers were able to rely on Social Security as a source of income in retirement, and a lot had pensions with their employers. We're not seeing that anymore. So we don't have as much in the way of options with those. And even if we do, they're not going to be enough to help us save everything that we need to retire. So the gap is growing. More workers are staying in the workforce even past the age of retirement because they just don't have enough saved. But you can also see here that there's a ton of money tied up in these retirement accounts. And the good news is that they are growing. But we as individuals now, the onus is sort of being put on us to take more control over what we're doing with those funds. For example, the traditional IRAs, that $9 trillion, half of that is coming from rollovers from old retirement 401ks, old retirement plans. So a lot of us have been in corporate America. Some of us have left our jobs, or maybe we've left corporate America to start our own businesses, and we have these old plans sitting there not doing anything. So now it's on us to decide what we want to do with that. So I think that this is just kind kind of painting the picture for why alternatives, and many people I think have realized that interest in alternative assets has been. So as far as self-directed IRAs, there are several different account types even within this category that you can establish or that you can open for yourself. And I think most people are familiar with the traditional IRA, which is basically your standard tax deferred account. All your funds go in pre-tax, you invest them over time, and then when you take your withdrawals or distributions later on, you're responsible for paying ordinary income tax on the distributions at that time. A Roth works pretty much the opposite way, in that your funds go in after tax and then your earnings grow tax-free. So as long as you take a qualified distribution from a Roth IRA, all of those gains would be tax-free withdrawals. So that's a beautiful option if that's something that you can do. And then if you're self-employed, there are plans that are specifically designed for business owners, and you can see those here: SEP, Simple, and then other qualified plans. And one of the biggest differences in those is the ability to make more personal contributions into those accounts. So if you don't have a job with corporate America, you don't have a 401k that you can roll into an IRA, how can you start building the value within an account for yourself? Because if you are a business owner, you're working hard, you're probably making good money, and these accounts allow you the ability to take a percentage or a portion of what you're earning and put them away into your retirement account. And sometimes those can also have tax advantages, like the ability to deduct those contributions. And then lastly, there are some non-retirement accounts really that actually are can be self-directed too. And that would be the education savings account. They allow you to strategically invest those dollars, and you can withdraw them tax-free for your child's education expenses. And then everybody knows what HSAs are, but a lot of people don't realize that those accounts can be self-directed as well. And then you can withdraw those funds tax-free for medical expenses. So here, I think we wanted to do a quick poll. And we wanted to ask you all, if I can pull this up, what types of retirement plans do you currently have? So I'm going to launch the poll. So if you could think about what you have that you know of and let us know. All right, responses are coming in. It looks like the leader is, well, it's changing rapidly, but it looks like the leader is the traditional or Roth IRA. About half of you are saying that you have those. About a third of you are saying that you have an active employer-sponsored plan. A quarter of you are saying you have an old employer-sponsored plan. So it's possible that that's not being actively invested, and that could potentially be rolled over into an IRA or other type of account. And then about a third of you are saying you have a business owner type account, so SEP, Simple, or solo 401k. So it's kind of all over the place. Thank you for those responses. And that makes sense that it would be a variety, and the majority would probably be in traditional and Roth accounts. Okay. And I just shared the results so everybody could see. And bear with me, this is my first time doing the polls on Zoom, so I'm just figuring this out as I go. Okay. All right, let's move on. So options for getting funds into a self-directed IRA. And I think there were some questions that were submitted prior to the webinar that some of you had put in when you registered. And I took a quick look, and we'll address them later, but somebody did ask, if you have an IRA already that's not self-directed, can you move those funds into a self-directed IRA? So the answer is yes to that. That would basically constitute a transfer. So there are a few different ways you can get money into a self-directed IRA. You can make a personal contribution, basically out of pocket from your checking or savings account. The IRS does set limits on how much you can contribute annually, depending on the account type. So it is important that you're aware of that. You can transfer from an existing IRA that you might have with another institution that doesn't allow you to invest in alternative assets, like Fidelity or Vanguard, for example. If you wanted to take a portion or all of those funds and move them into a self-directed IRA, you would simply liquidate your assets on that side so that you have cash in the amount that you're looking to move, and then there would be a trustee-to-trustee transfer of that cash. And I think the question also asked, is that taxable? The answer is no. Not a taxable event if you're moving funds from one type of IRA to another like IRA. If it's from a non-self-directed to a self-directed, that's fine, not reportable, not a taxable event, and there are no limits to the amount of transfers that you can do. So for those of you then in the poll who answered that you have an old employer plan, this is where the rollover comes into play. So you have the ability, if that plan's not being actively managed, if it's just kind of sitting there idle, you have the ability to go to that administrator and ask them to roll it over into an IRA. It's completely up to you if that's something that you want to do, but for educational purposes, I just want to make sure that everybody understands that is an option for you. And the process is considered a rollover, where they would essentially either wire those funds or send a check to your new IRA's custodian, who would then deposit it into your account for you. And then moving funds from a tax deferred account like a traditional to a Roth, which is an after-tax account, you can do that, but it's called a conversion, and that creates a taxable event in the year that you do it. And then once you have that conversion completed and the funds are in your Roth, it grows tax-free. So here's the more interesting stuff now. Possible investments. So this is what makes self-directed IRAs so interesting. What you actually can invest in that you're typically not able to with regular plans. So obviously today we're going to talk about real estate, and even within that space, there's direct real estate ownership. You can purchase raw land. There's private real estate, private equity, like investing in private REITs or joint ventures and partnerships. There's so much that you can do, even within the real estate space. Mortgage notes as well. You can buy non-performing notes and your IRA can collect on them basically. And then hedge funds as well, private stock. And then outside of the real estate space, you can see there are all these other things that you could do. And in the real estate space, private lending is huge with IRAs as well. So the IRS basically allows you to invest in any of these things that aren't publicly traded, with the exception of just two things: no life insurance and no antiques or collectibles. So as long as the asset class that you're looking at does not fall into those two restricted categories, you are free to hold it in an IRA. So here I'm going to do the next poll. We only have two, so this is our last one, to ask you all, what investments are you interested in? So take a minute there and let us know. So far, everybody says real estate, notes and loans, private equities in third place. And okay, there are a couple people interested in cryptocurrency and metals. Okay, but for sure, everybody, and to no surprise, everybody in this room is interested in real estate. And I think actually notes and loans are a close second. Yeah. Okay, so thanks everybody for sharing. I'm gonna end this and then I'll share the results real quick. So you can see everyone said real estate. And then about 20% said private equity, a third of you said loans. Okay. So we're at the right place here with a focus on real estate. So essentially how the funds flow with a self-directed IRA, because we get this question a lot, like, okay, I understand you're saying I can invest in this thing, but logistically, how does this work? Like, do I as the account holder, do I get involved? Do I take the funds out? How do I take the funds out without getting taxed? So the answer is that you don't personally take the funds out when you're investing with your self-directed IRA. And that's why the role of the custodian and administrator is critical, because here in the middle, you see that you're working through the custodian as a party on behalf of your retirement account. So basically, we're talking about self-directed accounts, meaning that you as the account holder, you direct us to make an investment on behalf of your IRA, and you tell us what it is that you want to invest in. And again, since we're not advisors, we don't authorize any investment transactions without your approval or your direction. So essentially, if you wanted to invest in something, there would be cash in your self-directed IRA. You'd direct us to take that cash out and put it into an investment or acquire an asset. We would process that transaction for you on behalf of your account. And then once that generates some sort of earnings or some sort of return, that return is going to come back and flow directly back into your self-directed IRA. and it would come to us as the custodian or whoever you choose as your custodian for them to deposit it back into your account. And that's important too, because when we're dealing with tax advantage accounts, it's critical for all of this to be coded properly, documented properly, so that the tax advantage status of the account is being protected and nothing is triggering a taxable event. So that is essentially how the funds would flow, and that illustration tends to be helpful for people that are new to this. So now I'm going to get into a little bit more of the weeds on a few different strategies when it comes to thinking about self-directed IRAs. So I start with this one because this often is one that people don't think about. They think, oh, this only pertains to me if I want to have my own self-directed IRA and do my own investments. But that's not really true, because think about the previous slide and the trillions of dollars that are in self-directed IRAs right now. And if you are somebody that is looking for investors or looking for funding for any of your deals, you could accept funds from a self-directed IRA as an investor. So think about all the trillions of dollars that are out there that could be untapped potential for you. So one way that you can accept funds from a self-directed IRA investor is through a note where they would basically lend you or your company funds associated with acquisition of a property or any piece of your business, right? You agree on the terms with that IRA holder, interest rate, maturity date, payment schedule, whatever it is that you two agree on, as long as the interest rates are reasonable within market rates. And then the IRA would earn its payments and principal and interest back to the account, and that would be its investment return. So if they're getting 10% interest, that's a 10% return on their investment, which tends to be better than the market would yield over a long period of time. And then the other way to do this is have an IRA potentially invest directly as like a partner in a deal with you, or just do a straight equity investment into your company. There are a few different ways to do that. But in that case, it's more of like a private placement where the IRA is going to invest directly, and then maybe it's going to receive dividends back in return, or it's going to receive a portion of proceeds from sale in association with its investment. So it benefits the IRA because they're getting now this more passive income into their retirement account, and then it benefits the person on the other side because they're getting the funding that they wanted. So and also, it's important to ask this question because for some investors, they'd be happy to invest with you, but maybe they don't have enough cash to do it, or they don't want to take all their cash and put it into it. So if they have funds in a retirement account, this is another avenue that they can tap into and that you can, potentially ask about to make sure that you understand all the different options available. So the second strategy is sort of as we just described, but if you wanted to open your own self-directed IRA, you could basically act as a lender. So again, it's another passive investment. The IRA would be the lender. The borrower could be an individual or it could be an entity. And then the IRA is going to execute a promissory note. The lender is the IRA's name on paper, not your name. And then we as the custodian review that, we sign off on it, and then we would send the funds out to the borrower with your direction, as I explained earlier. And then just a reminder that as principal and interest are paid back, everything's falling directly back into the retirement account so that it's not triggering any tax or tax responsibility at that time. So then the last strategy is using a self-directed IRA to directly invest in property. This can be done in the name of the IRA, or it can be done through an LLC that is created to be owned by the IRA. So without getting into too much detail on that now, because I know we're in 101 today. We're going to go into more in subsequent sessions, but I just want to get everybody's kind of creative juices flowing as far as what are all the different things that you can consider with an IRA. So when purchasing property directly, you can either buy it in cash if you have enough to cover the entire purchase with your IRA, or if you say, I want to purchase property, but I don't have enough in my IRA by itself, what are my options? You can you can leverage, you can get a non-recourse loan, which is the only type of loan that you could take in association with an IRA when you're using one, which basically just means that if your IRA defaults on the loan, the lender's only recourse is to foreclose on the property. So basically the property is the only collateral. The lender cannot, you can't personally guarantee that loan. The lender can't go after your IRA's other assets or any of your personal assets in association with that investment. If you decide you don't want to get a non-recourse loan, you can partner with other investors, and those can be other IRAs. You can have multiple IRAs partnering together into a deal, or you could have one IRA and three, individuals, or two and two, or whatever. So you can get pretty creative here too. And then, of course, purchasing a property, you're either going to think about fixing and flipping, where when you eventually sell that property, your IRA is going to take, its earnings on the sale. And then if you buy and hold it, you're going to own that over a longer period of time in your IRA, and then all that rental income is just going to flow to your IRA, passive income again. And then we just talked about partnering as well. So something that is important to be aware of, and this all sounds lovely, the IRS does have rules. So the IRS does have certain regulations that need to be followed when someone is investing with a self-directed IRA. And if those are not followed, they have defined what they call prohibited transactions that you are not permitted to do with a self-directed IRA. This education is important, and it's also important to work with your self-directed IRA custodian, because they should be familiar with these regulations to guide you through the process of doing this. So there are three different types, and it's essentially the first type is of prohibited transaction is using a self-directed IRA to do a transaction with a disqualified person. The IRS defines disqualified people as, I'm going to skip ahead real quick, yourself personally, your spouse, and then any of your ascendants, descendants, and their spouses. So if you think about your family, like lineage in or your family tree in like a lineal fashion, that up and down direction of relationships and your family, those individuals are not able to do a direct transaction with your IRA, as well as any professionals that are providing service to your account, like advisors, attorneys, CPAs. So you want to think about that, because an example of this would be like, I have a property, I want to buy a property in my self-directed IRA, but then I want to sell it to my children down the line out of my IRA. That wouldn't be an option to directly do that transaction and sell it to them, because your children are considered disqualified people from your IRA. So that's how they define that one type. The other type is what we talked about earlier with lending, where credit cannot be extended to between the IRA and a disqualified person. So again, if you're taking a loan in association with property, you can't personally guarantee it, nor could any disqualified person guarantee that loan. Nor could you use your self-directed IRA to lend money to a disqualified person. So really the idea behind this is that this is more of an arm's length, these are arm's length transactions, and these are for investment purposes really only, and the retirement account should really be the one benefiting from this, not necessarily your personal accounts now, if that makes sense. And then the last type is self-dealing, which is a little bit more of a gray area, but it's essentially a case where an IRA makes an investment, and then the IRA owner or some other disqualified person is also benefiting. So kind of like double benefiting. So an example of that might be self-directed IRA invests into a company. It's not owned by a disqualified person, but maybe, let's say I use my self-directed IRA, I invest into a company, but I'm also doing consulting for that company. So I'm taking a fee for my services personally as well. So there's a double benefit there, as you can see. So really, again, focus on using this for investment purposes and not trying to commingle, personal funds or personal benefits in the short term. So to kind of make this a little bit more relatable, because I talked about conceptually, some examples of how this would apply to real estate and prohibited transactions in real estate would be, for example, you buy a property with your self-directed IRA, but then you need to pay property taxes or for maintenance and repairs, and you try to do that with your personal funds. That wouldn't be allowed, because if the IRA owns the property, it's responsible for all expenses associated with it, just as it is entitled to all the income associated with that investment as well. Another big one is sweat equity. So repairs cannot be performed physical repairs cannot be performed on the property by any disqualified person. But in most cases, investors are not doing that themselves. They're using contractors, or they're using a property management company. So that as long as you're not trying to do those things yourself, it's not an issue then with a self-directed IRA, but important to keep in mind, no sweat equity. The other thing is not allowing disqualified persons to live in the property or rent it out or use it. So if you own a rental in your self-directed IRA, you wouldn't be able to have your family members renting it from you. They should be unrelated tenants renting the property. And then the biggest biggest mistake that people make is getting into a transaction or getting into a real estate deal, putting down the deposit personally, signing the contract personally, and then coming and saying, oh, I want to put this in my self-directed IRA. Unfortunately, at that point, it's too late, because by getting personally involved and making a personal deposit, you've now given your IRA an advantage to get that property, and that's considered prohibited transaction. So best to, if you're thinking about doing a real estate investment with a self-directed IRA, set up that account first and get everything situated so you have your IRA established. And then when you're ready to make a deposit or put in an offer, everything's done in the name of the IRA from the get-go. So usually the next question is, and I'm sure there are a lot more specific questions that I'll address shortly, and I think we're okay on time. But usually the next question is, if I want to do this, where do I start? What do I do? And how does the process work? So essentially what you would need to do if you don't have a self-directed IRA and you wanted to pursue this is you would need to establish a new IRA that's a self-directed one with a self-directed IRA company or custodian. And that would require just filling out an application. Once that's done, it takes about 1 to 2 days to get an account established. And then you decide your funding method, which we had gone over those earlier. Are you rolling over from an old plan? Are you transferring from an existing IRA? Are you making a personal contribution? And then depending on what you're doing, there would be some paperwork involved in getting that done as well. That can honestly take as little as a few days or a couple weeks most of the time, just because one of the factors out of our control is the other institution releasing your funds. So we try to move as quickly as possible on that, but we also have to depend on another institution to let go of your money, which they don't love to do. But then the last step in the process is making an actual investment. And as I had described before, you are identifying the investment that you want, make sure that you're comfortable with it and you feel good about it. And then you direct your custodian to make this investment for you by filling out some paperwork, basically a direction of investment type of form, and then all the supporting documentation for your investment. So if it's a real estate purchase, the contract, eventually the deed, those things are all going to need to be provided to your self-directed IRA custodian so that all of that is documented and on file. So usually there is a review process. Essentially, it's like a compliance review that the custodian does on your documents, and that usually takes several days. So you want to keep that in mind when it comes to timelines and whatnot, that getting that documentation together and doing it accurately and getting it over to them as quickly as possible is going to be your best practice. And then once that documentation has been reviewed for accuracy, the transaction will be processed. So, and then any future transactions that are needed in association with your account go through the custodian. You just direct them, you give them your authorization, and then they will process either funds coming in or funds going out from the account. So essentially, to just wrap this all together, there are several benefits to even just understanding this concept and being aware of self-directed IRAs out there in the marketplace. If you have a network of investors, find out how many of them have one. You might be surprised to know that several of them do, a handful of them do. And maybe we should have had a poll to ask how many of you already have one of these. I'm sure that some people in the session today have one already. And then there are others that might have just heard through word of mouth about them, but didn't know enough to maybe take the next step. So that's another option. And then of course, you can tap into, as we had mentioned, assets that are being held in retirement accounts that may want to invest with you. So asking the question of someone, do you have an old 401k that you're not using? Do you have funds in an IRA that you might be willing to use to invest with me? There's a lot of power in that because that could open up another avenue of opportunity. So with that, I think we are done with this portion and we wanted to get into some questions. I just wanted to state quickly that I know that was a lot of information, especially if you're new to this, a lot to take in. But there's also a ton more information on the website if you wanted to kind of just do a self-paced journey here. On the website, there are white papers that can be downloaded on different topics. There is a library of on-demand webinars on different topics that you can access. There's a ton that you can do just kind of self-service on the website. And then of course, if you wanted to speak to somebody, you can get in touch with us through the email address here or phone number as well. We're all, like a lot of people, we're mostly remote, but we have all full remote capability with our phones here at home, so we can be reached during regular business hours. So with that, I just want to thank everybody for their attention. And I guess we can get into the questions, Anthony.
We sure can. And thank you, Brittany. Just want to let everybody know that this slide that you're seeing right here will be sent to everybody. So you will have this information from Brittany's team in the marketing team. So you can always have access to getting a hold of Brittany, because this was a very informative. There's a lot here. And I'm sure you guys are going to have more questions. Let's go to Q&A first before we go to the chat room, because there's several questions in the chat, several questions in the Q&A. If you already have a self-directed IRA account, can we open another account with your company?
Yes, absolutely. You can have as many self-directed IRAs as you would like. You can have them at multiple institutions. Sometimes investors decide they want to consolidate what they have and move everything into one. So you have that flexibility. If you do have investments already in another account, another self-directed IRA, and you wanted to move them, that can also be done without having to liquidate those investments. So that is a good question.
Well, thank you, Brittany. Can the funds in a self-directed IRA be transferred to a 401k, IRA, Roth IRA, or retirement account?
So I just want to make sure I understand this question. So can funds that are already in a self-directed IRA
be transferred over to a 401k, an IRA, a Roth IRA, or other retirement account?
Okay. I'm going to make an assumption on part of this question, and I hope that I'm correct in assuming what it's asking, in that if funds are already in a self-directed IRA and somebody wanted to transfer them back to another type of account, could that be done? So if funds or investments are in a self-directed IRA, they could be transferred into another IRA. If, for example, let's say you were investing in real estate, you liquidated your investment and you no longer wanted to self-direct, you could take that cash and transfer it back to your IRA, for example, with Schwab or Fidelity, and that would be fine. However, if you wanted to move it into a 401k, there are different rules as far as how accounts flow from, or how funds can move from an IRA to a non-IRA. So it's going to depend on what type of self-directed plan you have and then what type of plan you want to move it into. But as long as they're eligible to move into that account type, then yes, you can. Hopefully that answers the question.
Sounds like, sounds good. Thank you, Brittany. Do you recommend one per property or several properties in a single self-directed IRA?
Great question. So I can't necessarily make a recommendation, but I could tell you the difference and that what some of the potential consequences might be of doing it one way or the other. So one of the things that's important to understand is that when an IRA, if an IRA gets into a prohibited transaction, as we discussed earlier, hopefully it can be corrected if it's not a significant problem with the transaction. So the first course of action is usually to try to get that corrected with the account holder. If it is a complex issue, it sometimes warrants bringing in an ERISA attorney to try to help correct the issue. And then worst case scenario, if it cannot be corrected, what happens is the entire IRA would get distributed back to the owner as if they took a full withdrawal of everything in that account. And then, of course, that would be potentially subject to penalties and or taxes. And the reason I'm explaining this, which ties back to the question, is that let's say, for example, you have one IRA and you own 3 real estate properties. There are 3 properties in that IRA. And with one of the 3 properties, you accidentally you did a prohibited transaction or something you weren't supposed to do. Now, all 3 of those assets that you own are potentially, worst case scenario, getting distributed to you. So what some of our longtime investors like to do that have lots of alternative investments in IRAs is separate them out. So have a separate IRA for each property, for example. So that way, if something happens with one property, it's only in one IRA, and that one IRA is the only one impacted, and the other 2 IRAs would be completely separate from that. So that's a really great question that we don't get a lot, but I'm glad it was asked, because that is something that as people start to get more involved with self-directing and maybe increasing the number of investments they hold, that is something to be aware of. But it's not commonly something that comes up with someone that's newer to using a self-directed IRA.
Okay, thank you, Brittany. We have Dent from Richfield, Connecticut. Welcome, Dent. Curious about as to the costs and timing from start to finish.
Great. So costs are typically going to look like a small one-time setup fee to process your application. The primary fee is going to be custodial fee. That's going to cover those services like the tax reporting, 1099s, 5498s, the record keeping, the online access to your account, that sort of thing, statements that are sent out every year. So every company is a little bit different. Our fee schedule is available on our website, but I can tell you that we offer 2 options for the custodial fee so that you can decide which is more cost effective for your situation, because it does vary. But essentially, the one option is a flat rate per year for each asset in your IRA. So regardless of the value or how much it might grow, you're just paying that flat rate every year. The second option is a value-based calculation. So it looks at, regardless of how many investments you have, what's the value, the total value of that one self-directed IRA, and based on that value, it's assigned a quarterly fee. So that's going to be the primary fee, and then you're also going to see transactional fees. So for purchasing an asset, for liquidating an investment, there are going to be transaction fees for those. And that's very common in the industry. I would definitely suggest checking out the website for the fee schedule so you can view it in detail. And then I think we can also, in our follow-up, we're happy to provide that as well. And then there was a second part to that question, which just completely slipped my mind. Question was about fees and the other piece of it.
Cost and timing from start to finish.
Okay.
Timing.
So the timing really can vary. And we try to be really conservative when we provide an estimate. And I'm sorry, the sun is coming in on me now, so there's a glare. We try to be conservative and say, from start to finish, if you know that you're going to want to do something, allow 4 to 6 weeks to get everything set up. Meaning to get the application done, submitted, account open, funding sent over, investment paperwork submitted, reviewed, and then the actual funds sent out. Now, it's not to say that it always takes that long, but because of certain variables that, again, with the funding, for example, we don't have full control over, we suggest that before you pick an investment, start thinking about taking the steps to establish your account. usually then the next question becomes like, okay, well, if I open an account, do I have to do an investment within a certain period of time, or do you have a minimum? And no, we don't. Of course, it would make sense to, if you could fund your account within a reasonable amount of time after opening it. But because it's self-directed, you could technically at least just get the account established. And then you're already ahead of the game when you find an investment you want to do, because you don't have to go through that whole account setup process. Now we're just moving the funds, we're getting the investment docs together, and then likely it's a matter of maybe a week or two to get that all teed up. So hopefully that helps. But I'm glad that question was asked too, because a common misconception tends to be that this works similarly to your regular IRAs. And this business model with alternative assets is so different and unique because each alternative asset is completely unique, right? Like we don't have a platform of pre-approved assets or a menu of investments to choose from. Part of the beauty of it is you have the freedom to go out and find your own, the ones that you really want, that you feel good about. But at the same time, that means that it comes with a layer of customization and a little bit of manual review that has to be done. So it is going to be a little bit more involved than just a simple, click of a button to trade stock, for example.
Great. Thank you, Brittany. Actually, I'm going to go back to Michael's question, who asked you about, do you recommend one per property or several properties in a single directed IRA? He's also asking part two, who is the starting point to work with? CPA, financial planner, estate planner, or an attorney?
Good question. So it really varies depending on how much investment experience you have, how comfortable you are making your own decisions, what level of experience you have with IRAs already. So it's really going to depend, but usually those that are most successful with the strategy do have a solid network of all of those. So they have a good attorney. And usually when you're working with self-directed IRAs, you want to have an ERISA attorney, or an attorney that is familiar with ERISA law, so that they can guide you and interpret Internal Revenue Code related to issues around using your account and that sort of thing. A good CPA that understands, just in general, understands IRAs and that sort of thing. So if you're not sure what type of account to open, for example, they're going to be your resource to understand your particular circumstances and recommend what account type is best for you, or what contributions you should be making, for example. And if you would like to work with an advisor that has the ability to advise you on these types of assets, you're certainly free to do that as well. So I think, again, going back to, it depends on the person and how comfortable you are making your own decisions. But if you're not, and you want to have, or you just maybe want to have that network sort of behind you in case something comes up and you need an expert opinion on that, then that makes a lot of sense as well.
Great. Thank you, Brittany. Sandra from Oceanside, New York. Can you move, you may have answered one of these already. Can you move an existing IRA into a self-directed, or does it cost taxable income?
Yep. So that was the question that I answered, that I had seen ahead of time, that I answered earlier, and the answer was yes.
Yeah, I thought I heard you speak about
okay.
that. Okay, so great. Let's go with Peter. Peter is okay. I believe Peter's in Washington. Okay, managing member. Okay, how can I use the property value of real estate in a self-directed IRA to purchase a second property?
Okay. So in the case that you purchase real estate in your self-directed IRA, and let's say you then sold that property, and you received cash back into your IRA, you could simply reinvest that cash. So I think that's probably the simplest way to answer that question, in the sense that, and hopefully that's what you were asking, or what you were looking to understand, is because we do get that question a lot, is like, okay, once I've done one investment and now I'm finished and I've liquidated it, now what do I do? And the answer is that you can reinvest that cash as much as you want. So, and actually, usually that is, for some of the most successful investors that we hold accounts for, that is what they do. They don't stop at one investment. They continue to reinvest and reinvest that cash so that they're constantly putting into something to grow over time. So you have the ability to do that. And even within the same account, you can use that cash for different types of investments. It doesn't all have to be real estate in one IRA. It could be, a property, it could be a note, it could be cryptocurrency, it could be a partnership, all within the same self-directed IRA. They're just considered different assets in your self-directed portfolio, if you will.
Thank you, Brittany. I'm not sure if you can answer this question. I'm not sure if he's looking for help. Owner looking at Tennessee for purchasing of properties. Now, is that something you're just looking for properties to buy? I'm not sure.
Yeah, I think it might be. Unfortunately, that's
Yeah.
not something that we could help with in
Yeah.
terms of finding an investment.
Yeah, I was just wondering if you do know of properties, I guess. Do you ever get involved with that? That could be something differently, but do you have listings of other properties or not really? It's almost like a 1031 exchange or something of properties.
Yeah, that's not listing of even listings and that sort of thing, because we have that restriction that we're not fiduciaries and we don't sell or endorse investments. We're not able to share specific investments like that. However, we do sometimes have networking events that we host for our community, and our community is made up of investors, financial professionals, brokers, etc. So getting involved in perhaps some of those events or some of those sessions and kind of throwing that out there, connecting with others might be a good way to get some suggestions or ideas from other investors as well.
Got it. Arlene, is there a time for how long you have to identify and close on a property after setting up the SD IRA?
Good question. We sort of talked about the first part of that. Is there a time that you have to identify an investment once you set up your account? No, there is not. And then once you acquire a property, you're able to hold it as long as you'd like. So you can hold it in there for the life of the IRA if you wanted to. For example, if you were going to buy and hold something, there is no deadline that you have to liquidate that or sell that at all. So you have a lot of freedom there.
I know Arlene asked another one, a timeline, so I think you answered that.
Yes.
Okay. Let me see here. Michael is asking another question. It sounds like a self-directed IRA would obviate the time-bound limitations of a straight 1031 deadline to identify.
Could you repeat that, Anthony? You cut off.
Okay, Michael's saying it sounds like a self-directed IRA would obviate the time-bound limitations of a straight 1031 deadline to be identified.
Yeah, so yeah, we get questions about 1031s pretty often.
Yeah.
And essentially it would kind of be like a non-issue, because if you're using a self-directed IRA, you purchase a property, you sell it, cash goes back into your IRA, you're not responsible for capital gains because it went back into an IRA. So you're not restricted, or there's no criteria for you to have to purchase another property, for example, in another period, at a specific period of time, because the self-directed IRA by nature is already deferring all of that. So it's sort of like a non-consideration when you're using self-directed IRAs.
Okay. I'm not sure about this first one. I'm not sure if you answered this one already. Karim from New York. Managing partners, the implications of debt used at property level in a real estate private equity transaction. IRA is investing in an entity that is the GP of the LP of a propco that was bought, that bought the property with the leverage.
Okay.
Okay. Should I read that over again?
I think, yeah, I had looked at this question earlier,
okay.
and I'm going to take my best stab at it.
Okay, great.
I'm sorry, the lighting in here, as the sun is moving, it's just, I can't.
You're fine, Brittany.
At least the sun is shining today, so we'll take that. So I had reviewed that question, and it probably warrants more discussion, but what I can speak to in that question is what happens if there is debt involved in a purchase. So for example, let's say this was like a syndication, and an IRA invested into an entity that was then going to go out and purchase real estate. So the IRA is maybe an LP or minority investor or whatever. And that entity goes out and purchases real estate and then takes a loan in conjunction with it. There is potentially a tax that could apply to that called unrelated debt financed income tax, which basically says that it basically looks at the portion of debt as a percentage of the total investment, and whatever percentage of debt was taken on to make that investment could be subject to that unrelated debt finance income tax. So it's probably it's something that we could go into a completely separate like seminar on and do just probably on its own. But I think that's where the question was going, and hopefully that answers it to a point. And then that unrelated debt finance income tax warrants further discussion and a little bit more research to make sure that it's fully understood.
Everyone, we have about maybe 3 more minutes left. I know there's a lot more questions coming in, but please, you will receive Brittany's email address, and I'd like you to continue asking her questions there afterwards. So please submit your questions to Brittany. I'm going to just ask her 3 more questions and I'm going to wrap it up, but I know there's a lot more questions coming in. So can we use personal funds along with the funds in an SDIRA to purchase real estate, or should all monies come from the SDIRA?
Great question. So technically, personal funds can be used to partner with your self-directed IRA. So let's say that you needed 100K for a deal, and you had, for simplicity's sake, you had 50K in your IRA, but you had 50K personally that you were able or willing to invest. Partner with your IRA, in this example, 50-50 split. You could do that, but because, as we mentioned earlier, you are considered a disqualified person from your IRA, what happens is you have to go into that investment up front knowing exactly what percentage of ownership your IRA is going to have and you're going to have, so that you fund the investment, in this example, 50-50 simultaneously. And then throughout the course of the investment, everything would have to be split 50-50, so that you're responsible for half the expense, your IRA is responsible for half, and then same thing with any income flowing back in. 50% of it goes into the self-directed IRA, which is going to be tax sheltered, and then the other 50% goes back to you personally, which is subject to regular, tax. So it certainly can be done. We definitely have clients that do that, and it's just important to make sure that you understand the rules to follow when doing it. So yes.
That's great. Brittany, is there a minimum amount needed to start an SDIRA?
There is no minimum required. Of course, the only thing that we would suggest, or I would suggest, is that you consider the fees that you're paying. And if you're looking at moving over a small amount, and whether it makes financial sense to do that, considering the fees that you'd be responsible, the custodial fees that you'd be paying. But we don't require a specific minimum.
Understandable. Just wanted to clarify, you can use real estate owned as asset to the SDIRA?
I probably would have to get more clarification on that question, meaning, is that real estate owned by you already? But if I make the assumption that that's what you were asking, or if we go with that, if you already own real estate, it's too late to put it into your self-directed IRA, because essentially you'd have to sell it to your self-directed IRA, which is a prohibited transaction. So if you want to use your IRA for real estate investments, you would be looking at purchasing a completely new property that you don't already own. Hopefully that answered the question.
Is there a 529 equivalent to the SDIRA?
That's so funny. This came up. I did a webinar last week and the same question came up. And I wish that there were, because I have a 7-month-old and we just opened a 529, but there is no option to self-direct that I'm aware of. The education savings account is the self-directed option, and the education savings account works a little bit differently than a 529 as well. The contribution limits are smaller, but there have been cases where clients have invested multiple or partnered multiple ESAs together and into an investment that did well. But unfortunately, I'm not aware of any 529 equivalent. I wish that there were.
Great. I am okay here. Hey, Gerard, Michael, I'm going to send Michael's email to you, Gerard. He can help you find a Tennessee property. So I just want to put that in there real quick. On death, does the SDIRA pass to the heirs as set up in a will or trust agreement? The
Yep.
heirs.
So yeah, it would essentially work just as it normally would if you had an IRA and you elect your beneficiaries. So you could either elect individuals as beneficiaries, in which case those individuals would then inherit whatever's in your account at that time. So if you have assets that you own, the asset either is going to transfer into, they would have to open a beneficiary IRA or an inherited IRA, and then they would receive that asset or cash or whatever combination of assets you have. Or you could, if you have a trust, you could list that trust as the beneficiary of your IRA, and then everything would flow through that trust. The custodian would just need a copy of the trust document so that they understand the process to follow. And that trust should be irrevocable upon your death, but that is an option as well if you didn't want to just elect specific beneficiaries.
Great. Brittany, that was fantastic. That was a lot of fun and really, really informative, and we want to thank you. Brittany, tell me a little bit. This was part one. We're going to have part two at 3/31 and part three, of course, 4/28. You're coming back each month because you have a 3 series here. Your topic, a panel discussion on self-directed IRAs. Real estate experts share real-life investment stories. Explain to me who those real estate experts will be as your guest.
Yep. So we're planning to have a diverse panel. So it'll probably look like a combination of investors, agents, investment sponsors. So individuals that have specific investments that they're selling. We may also have a client or two on. So we're still building out the panel, but it's going to definitely be a variety. And the idea is that we want, now that we've done 101 and you understand conceptually how this works, we want to share some like real life examples and real life case studies to kind of like dive deeper into the specifics. So very much looking forward to that. And then our third session is going to be okay, if you want to do this, what are some best practices for managing your account? So we talked about some of the rules to follow, what to expect, but we also want people to hear directly from self-directed IRA holders, what have they done with their accounts? What advice would they give to somebody who's looking to open one? What have they learned from experience that they would do differently if they, were to do it again? So we're very excited to share that, and obviously it'll be much more engaging than just watching me and listening to me speak. But I also have to say that I'm really happy to see that we got so many questions and that individuals were very engaged in the session. I know that it's a lot to just listen to one person right now, especially in the COVID era, and webinars are just the only option. So thanks everyone for your attention. Very much appreciated, and I hope you learned something valuable today.
I think we found one speaker for you for next month.
Oh, great.
We have Glenn. Hey, Anthony, Paul, and Glenn here. Great webinar, great stuff, great stuff. Brittany is great. Full disclosure, she handles our personal self-directed IRAs, and we work with some of next generation's accounts holders looking to invest. Great company. So
I think I know what Glenn that is.
Yeah.
I appreciate you, Glenn.
Galucci. Glenn
Yes.
Galucci. And
hi, Glenn.
he's something else. And yeah, thank you for that testimonial, Glenn. We
Love
appreciate that.
it.
Hey, Brittany, real honor. Thanks everybody for, registering, and we really are looking forward to seeing that panel next month. And I just want to thank everybody once again, and thank you, Brittany. Thank you.
Sure. Thank you for the opportunity. Hope everyone has a wonderful day.
Thank you, guys. Thanks, Brittany. Bye-bye, everybody.